Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our entry-level introduction into life insurance, our Edutrainment workshops, and all this week we've been doing our introduction into participating whole life. If you haven't seen Monday, Tuesday, Wednesday, and Thursday show, you need to go back to the beginning so you get an idea. And if you're just coming new to our course period, you need to go all the way back to the very beginning so that you can get caught up. And we've been using for the last 65 vignettes, think about that, 65 video vignettes, we've been using LBL's, Lincoln Benefit Life's, and Allstate Company's software called the Eclipse Illustration Software Package for most of our training because it has great tutorials and great educational inserts and wonderful consumer pieces inserted inside their software package. And if you want to go out to their site, www.lblsales.com/ETW. You can go to this site, hit Run Installer, download, and as you go back through all our courses, you can go page by page with us, and it'll really help your educational experience. Also, Lincoln Benefit and Allstate have a great menu of marketing campaigns and ideas, and the URL address is playing at the bottom of the screen, and it's also embedded in our search engine optimization document that's attached to this video. Just go ahead and copy, paste, put it in your browser. It'll put you right here, and as soon as you get here, you're going to see this great list. A couple points, the Facts of Your Life booklet. We love it because it's a great collection for client assets. It harvests information, great data collector, great fact finder, and it really has information in there that I think you're going to find extremely powerful for you and your client, and it's a great prospecting tool. Again, if you want it in hardback form, you can get it free, or just ask for the email attachment and they'll send it right out to you. Also, we have prospecting letters and postcards already pre-done. So if you're looking for first contact consumer pieces, this is excellent because it has very different ways of attacking the issue, and it's a good marketing campaign. Remember now, Allstate's already done their compliance and approved it, but if you're a registered rep, you're going to need to have your own broker-dealer compliance sign off on it, as well as if you're with an insurance agency that has compliant protocols, you're going to have to also make sure that they're okay with it before you move forward. And lastly, because we're getting so many people picking us up on YouTube, Vimeo, and other channels which are posting our stuff, which we thank you for that. Some people say, well, Steve, I don't even know where all your stuff is. So if you want to go out to our own homepage, www.brokersalliance.com, as soon as you come to our homepage, you'll see the red on-demand video button. Click on it, and all the archives of all our Edutrainment workshops, including this one, which is our Introduction to Life Insurance, it's all out there, including the Business Insurance Zone, our daily internet talk show, and my weekend show called Welcome to the Weekend with Steve Savant. Well, let's just get into it today. We're really talking about whole life, and it's an excellent piece. We've been doing this now for all this week, and I wanted to show you a basic idea here. I don't know if I can get any bigger than that. Let's just see if I can. And I'm going to just have to leave it then. I'm looking at this basic history of dividends to policy owners, and I noticed, look at this huge graph, kind of a steady Eddie graph until we get into the areas of high interest rates, but look at the accumulation of dividends from 1960 to 2012. When you think about it, this singular carrier, right, is paying out 1.3 billion in their huge dividend history all the way back from the 60s. And if you look at the dividend history here from 1960 to all the way out individually, you can see the dividends that they paid. And this is why I go back to this premise that I talked about yesterday and the day before. If you want to show 20-year lookbacks for actual dividends paid for whole life when you're using it for income scenarios as a comparison to Index Universal Life, comparing it to their S&P, I think that's a fair description, and you should be able to look at this, even though I know interest rate paradigms have changed in our day. But to be fair, if we're going to use lookbacks, this is where I'd start looking back. And yesterday's show had a ton of dividend information and historicity. Now what I want to do is I want to walk you through some of the present day grids based on the 2012 dividend scale. Okay, here's a grid, and again, we made it as big as we can, and I can send it to you. I just can't make it any bigger than we can on the Mondo pad to get everybody in. Now, what I'm looking at here is I'm looking at a basic contract for $250,000. We've been staying in that $250,000 realm. and male non-smoker, best class, and we're looking at a 40-year-old, and we're using an all-base premium policy grid. So I have several carriers. I probably got 20-something carriers here, but each carrier, some of these carriers have 2, 3 different versions of their whole life, and so you have to figure out which one you're talking about. And when I look at that, remember one universal truth, they're all using the 2001 Commissioner Standard Operational Tables. Now, even though I use for my LE, for life expectancy, and a lot of my modeling for planning, I don't use the 2001 anymore. That's a product CSO. I've been using the Society of Actuaries Value-Based Tables, the VBT, that was issued in 2008. Because I think it's a lot more accurate. It extends human longevity farther out. And when I'm doing modeling for estate planning, retirement planning, charitable giving, intergenerational giving, I think it's more accurate. So when you sit there and if you're doing this for the product, that's fine for 2001. But if you're doing it for actual modeling, for any kind of planning, financial planning, I think you need to be on the VBT. And some carriers, by the way, have already went over and migrated over to it. And even on their illustrations, they actually post the 2008 VBT tables. Or I'm sorry, they use the rates from the 2008 VBT tables. And I think if you haven't ever seen this before, just go out to the Society of Actuaries. Don't read the whole report, just read the graphic docs. That report's huge, and if you have an insomnia issue, that would be the thing to read. Now, when I'm looking at this, look at the variance of every carrier for a base premium for a 40-year-old male, non-smoke, best class. This always blows my mind that different carriers are going to be much more edgier than others. When you look at it, you're looking at carriers like this carrier down here is at $2,995. This carrier is at $2,000, leading by the way, $2,590. All this, then you have other ones that are much higher, sitting at $5,390. Again, remember there's reasons for this, but when you look at it all the way around, there could be a spread in the traditional indemnification scenario using whole life. There could be a spread of 20% between the leader and the ones that are sitting at the bottom 20 or the lower quartile. And you need to look at that because you have to say, hey, what kind of dividend am I getting that? If I pay more, am I getting a better dividend? But most of the time, if people are looking for indemnification and good dividend performance, there's really only a handful, I hate to say it, that are limited, and those top 5 contracts are really tough contracts to beat. So I look at the annual premium, and then I'm looking at the cash value. Again, I'm looking at the 10-year cash values. I'm looking at the 30-year cash values. So I'm looking at my first 10 years because if it's not really going to be a good deal in that 10-year and I have to wait longer to recover, then I don't know if this is going to be a good deal. And that's where a lot of people weigh out, is this a credible or an economically viable contract? So I do 10-year grids just to see what the cash values are to say, okay, that's making it. Some of these are not making it, and the internal rate of return reflects that, and that's why the others are chosen over them. I also look at the 30-year because sometimes some carriers, the longer they are, they're going to win in the 20, the 25 and 30-year numbers. And I look at the internal rate of return, not only cash on cash for that 30-year, but I want to look at the internal rate of return of cash. And again, when I look at IRR, most of the fiduciary market, enrolled agents of the IRS, CPAs, tax attorneys, trust officers, they all want to see internal rate of return. Nobody uses cost indexes in life with fiduciaries anymore. So if you're going to show them this, I want to see internal rate of return not only on cash, but I also want to see internal rate of return on death benefit. So in these cases, I'm going to look at the premium in and premium out and look at this over this 30-year internal rate of return. I have a couple carriers here. One is at 4.57, 4.49, and these are long-term now. And so those are the carriers I'm going to start highlighting. There's several contracts here. 1, 2, 3, 4, 6 contracts, 7, 8 contracts over 4% over that period, day in and day out. And then the internal rate of return on death benefit, if death were to occur, it's even going to be larger because the death recorder is going to push that death benefit. It's going to be bigger than the cash value. So you'll always have a terminal benefit that's greater than your cash value if death came early. And look at the internal rate of returns. Some of these contracts are in the high 7s. These are barely not making 8% in total rate of return after 30 years. So when I'm comparing this, I'm trying to look at, is this landscape, looking at the complete spreadsheet, the complete grid, is this landscape, which one would I choose based on money in, money out, internal rate of return on cash? This is the almost 90% of the market. So when I'm looking at this, I'm always quantifying which one am I going to and why based on IRR on cash values and IRR on death benefit. Now what I want to do is I want to go to a different one, a different grid, a different spreadsheet that actually shows the impact of how we play when we use term riders, and I'm going to use a 50-50 blend. Okay, so here's our 50-50 blend using the same male 40, non-smoker, best health consideration, and I'm looking at the entire grid here. There are a lot of caveats to this page because everybody's so different as you can possibly imagine. So I'm going to just stick to the grid, but if you say, Steve, I'd like to see this, I can give it to you. Send it, just ask me thebiz at brokersalliance.com. Just write me THEBIZ at brokersalliance.com and I'll send it to you. Now, interesting enough, here's again what we're looking at, the same grid format so that I can measure what am I getting with a lower number. Now, some people use this whole life and term against current assumption UL because they're both using maybe ART rates that aren't guaranteed. They're certainly using dividends, which are of course not guaranteed. And of course on the current assumption UL, none of that on the current side is going to be guaranteed. It's current company assumption interest rate, it's current COIs, cost of insurance. So some people like to compare those two because that's kind of equal footing as a lot of people think of it is. So you can kind of look at this and say, is this a good deal when you're using term? Now, usually when you're using term, you're trying to keep the premium down and you're looking for a permanent solution, but you just can't afford a complete base policy. So in here, we're using a 50-50 term blend. And again, you can see a couple carriers here, unbelievable, to age 100. And remember, some of these are at different age groups from age 100 to age 108 to age 120. So be careful what you're getting because the premiums are all over the board. Most of the leading carriers here for that kind of $250,000 benefit are just under $2,000. So in fact, actually there's one carrier that's almost creeping under $1,800 for that amount. Again, I'm going to look at the rate of return. I'm going to look at the cash value buildup for the first 10 years and see if it's worth staying in or should I have just went and bought 10-year term or 20-year term just to take care of it. I measure it off that 10-year number. If it's not making it then, it's not worth looking at. And that's why I want to make sure that once I cross over that 7th or 8th year, I should be winning with a good whole life contract. But I have to kind of stay in that time. So when I'm measuring it, I want to measure the longer the term contract, the more I want to look at this, especially if you're using term blend to keep the premium down. Again, I look at the 30-year and then the internal rate of return on cash. Now remember, we're using term now, so I got to pay a bill here. So I'm looking at the IRR. Before we were looking at the IRR, we're looking at lower numbers, but check it out. Some of these carriers actually are posting 4% with a term rider, by the way, and they're posting 4+ rates of return on 30-year cash value. Astounding. Then you look at the death benefit and the internal rate of return on death benefit. Look at some of these death benefit numbers. They actually exceed, well, that one's at 8.48, that one's at 8.49, 8.33. So there's several carriers here that crept into the 8% total rate of return. And of course, they showed also the guaranteed cash values, which by the way, are pretty good. When you put this against today's current rates, those numbers are pretty astounding when you think about it. But lastly, what I want to point out, and this is an interesting thought here, we're also posting what is the minimum blend possible. I was using for the grid 50-50 term blend, but then I said, well, let's put on the end of this, we're going to look at this grid and say, what's the minimum blended possible, the percentage of term? Now look at this, several of these carriers will go into the 90s. You could use 10% whole life on your base and 90% term. In fact, I think there was one carrier here, wow, 94%, so 6%, that dividend better be great, right? So when you're looking at that 94% blend on this product, and again, remember there's going to be age issues here that you're going to have to quantify, but 94%, 90%, 92, 90, 92, you can get these numbers way down. So there's several carriers that let you do what they call max blend, way beyond 50-50, and those max blends are very dependent on current assumption on their ART, annual renewable term, and especially on the dividends to pay those price tags and later on convert it. But there they are. So we've given you the 50-50 blend, everybody's equal, and we've also shown you the max term insurance blend that you could possibly use with each carrier.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.